Back to another video here on Financial Friends. Today we are going to be taking a look at 4 potential stocks that we might be adding to the Dividend Journey portfolio very soon. I just want to upfront this video with there will be polls on Public, a poll on Twitter, polls on Instagram, Facebook, this YouTube channel, the community page. I want you to all comment down below in the comments, recommend stocks, comment on these stocks. I want this to be a community-driven decision. Ultimately, the decision is going to be made by me and what I believe, but I will be swayed very heavily if the company that I am thinking is not what you all are thinking. So go ahead, spam in the comments, spam those polls. The links for all the social medias are down below. If you're new to Financial Friends and you're very confused right now, Financial Friends is a community of people who love business, finance, and investing related content. If that's you, consider subscribing and following on all the various social medias down below and that I just mentioned so you can help participate in this video. Now, the Dividend Journey, what is it first and foremost? It is a portfolio, a dividend-focused portfolio that I am building for forever, and I'm just tracking it here on this YouTube channel alongside of you guys. We are building a portfolio mostly of ETFs, but also some individual companies. I'm looking to add some individual companies or a individual stock. Here are a few of the different options. I had some more, but I don't want this video to be too long. How am I going to be breaking this video down? So I'm going to comment a little bit on the stock, a little bit on the financial health of each company, but then also on something that is real and tangible for this company, something that isn't just the data that is on this dividend tracker, which if you like this dividend tracker, go ahead, check it out. The link is down below. If you use the premium version, it does give a kickback to me that does help support the channel, and I would greatly appreciate it. However, the free version is amazing as well, so go ahead and check that out either way. Now let's go ahead, get into this. We're going to talk Procter Gamble, Starbucks, Target, and Visa. If you want to skip to any portion of this video, there will be timestamps down below. You can use those timestamps and help navigate throughout the video. First one up, Procter Gamble. Now this is a company I have been looking at purchasing in my other portfolios, as well as now the Dividend Journey portfolio, for a very long time. They do pay out a healthy portion of their profits, 59.04% of them, but they have a 2.48% dividend yield, which falls in line. They've been paying dividends forever. They have a very low beta, and you can see the growth of this stock over time. It is a pretty nifty looking chart over really the last 5 years. Nothing but really up. This company is established. They have pricing power. We'll see in a minute how they have some absolutely massive and noteworthy brands underneath their belt, and they're a really big company, right? Everyone knows who they are. Now they're trading at about a 25 PE ratio, price to earnings. They have a debt to equity of 0.5, but their current ratio, so current assets to current liabilities, is not really looking super hot. They have a relatively good looking outstanding shares, moving in that sort of downward direction. There was a little bit of an increase here, but then back down again in 2021. Nothing to be concerned about. I like the look of that there. You can see this revenue growth is from a very long time ago, but you can see that upward trend. I think that trend continues upward. That's something I would need to look at before making a decision on this company. You could see the EPS slightly up. There are a few hit or miss years every once in a while. That would definitely be something we would need to look into. I know they make acquisitions of companies and such, so that's always something that we're thinking about, of course. Now, the tangible aspect of this business. This is something that is really important to me. I want to understand how these businesses make money, lose money, etc. Also note the 83 dividend grade before we move on. We'll kind of compare those really quickly at some point. Investor relations. You can hop over here to their investor relations page. You can see 66 years of consecutive dividend increases. I think that is the most amongst any of these companies. Products in 180 countries. Procter & Gamble has been around since 1837, which is basically forever, at least in my terms, and 10 different product categories. Now, these product categories and the brands that they do have underneath their business are impressive. We've all heard of them. We all know what they are. So let me go ahead and try and navigate here. Here are, in 2021, the breakdown of their net sales and their net earnings from the different brands that they do have in their umbrella. You could see here, beauty, grooming, healthcare, fabric and home care, baby, feminine, and family care. Big brands like Head & Shoulders, Herbal Essence, Pantene, Olay, Old Spice, Braun, Gillette, Venus, Crest, Oral-B, Vicks, Pepto-Bismol. We have Downy, Gain, Tide, Mr. Clean, Swiffer, Febreze, Love's, Pampers, Always, Bounty, Charmin, Puffs, Tampax, right? The list of the absolutely massive brands continues to go on forever. Now, as someone who likes to understand where money comes from, how they stand to make and lose money, this is very simple. If they can continue to raise prices of their products slowly over time, not shock anybody with that, they will continue to be profitable along with inflation, because these are brands that people know, understand, love, and will continue to buy over the generic versions. You can see that net sales and net earnings come actually relatively equally, with grooming being the smallest portion of their business, which is actually kind of shocking. And then healthcare underneath that. Beauty, fabric, and home care, and baby and feminine care kind of dominate their makeup, but really just an outstanding business with products that people will continue to buy. Something to note is all of these brands are semi-consumer focused. That's what I understand, that's what I know. And with hard times looking like they might come here in the United States, it's something to pay attention to, but long term it's almost beneficial to me as an investor, as I can get these stocks at a discount. Now, touching quickly on the price action, you can see, like I've said, up and to the right over that long term, something that we haven't seen over the past year with the next stock, which is Starbucks. We've seen this company fall and fall and fall and fall. This is a stock that I do own elsewhere in my portfolio. I own about 2.52 shares. I know this says 2.05. Not necessarily accurate. I haven't updated it in a while. But Starbucks is one that I buy every single time I use the business. If I buy coffee, I buy $5 worth of stock. Every single time without fail. Dividend payout ratio, again solid. 10 years of that dividend plus, like I've said, I think it's a little bit longer. The ratio, or the yield rather, comes in good, above our sort of goal of 2.5, comes in at 2.57. Now we do have a PE ratio of 20. Like I said, this stock has been falling. I've been continuing to add. We do see that the current ratio is at 0.83. Starbucks is another brand that has huge pricing power. People prefer Starbucks. They like the brand. They like the logo. They do have some competitors with Dutch Bros kind of coming in more on the West Coast. Starbucks is relatively global at this point, of course, taking their business out of Russia recently. Not a big concern and not a big hit to their brand. Outstanding shares continuing to drop with those buybacks. Revenue back from 1989. I'm not sure why this is so old, but moving on up has continued to grow. I'm pretty sure it has continued to grow as well. Earnings per share, again, relatively consistent with that up and to the right trend. Minus 2020, which I think we can all kind of assume or know what that is from. Now into the tangible aspect of their business, something that I understand a little more, again noting the 74 dividend grade, is their market share in the ground coffee game. Now this was in 2020, which is a little dated, about 2 years ago, but 12.4% of the ground coffee market compared to the other big one, Folgers, which only has 25%. So you look at Folgers and you assume that Folgers would dominate this part of the ground coffee. Now this is ground coffee. This is in-store ground coffee, not the fast to go or drive-through or anything like that. Dunkin' at 7.8%, Maxwell House 10.5%, private labels make up 10.7%, and then you have Starbucks at 12.4%, double that, and you'll come to Folgers at 25.1%. So Starbucks is competing, and this is something that not a lot of people take into consideration when looking at Starbucks. They assume it's the in-cafe, to-go orders, mobile orders that make up the bulk of their business, but we forget they have creamers, they have ground coffee, they have coffee beans, they have seasonal coffee, coffee mugs. They sell coffee, ground coffee, and coffee beans, and those mugs, and snacks and food, water, all within their cafes as well. So they're not just this pick up and to go, make it through the drive-through, fancy coffee drink place. They actually have a 12.4% market share in the ground coffee within stores. They have the fast and ready-to-go drinks. They are multi-dimensional in terms of coffee. Of course, at the end of the day, it all comes down to coffee and their store sales. But this is a substantial portion of their business as well, at least noteworthy in terms of market share in the grand scheme of things. Moving on is another stock that I do own. Again, note the dividend grade. We went from an 83 to a 74 and now an 89. Target is one of those businesses that I personally will own in my portfolio forever, but I'm considering to add it to this portfolio. We've seen a massive fall off in their stock price. I think it was 25% in a day after some poor earnings. It's gained back a little bit of that. It's going to take a while to probably reach these levels again. I think they've paid for 50 years in a row. Correct me if I'm wrong down in the comments, but a 10-plus year streak for sure, at least shown here on the dividend tracker, a 2.24% yield, and just a 30% payout. This is one I'm excited for. This is a stock that I feel will continue to grow over time. Their business will continue to expand. They have a bit of pricing power. People expect and know, and they like Target. They like the brands that are held within it, and they've stayed on top of trends. This is massive for them. Instead of going to Walmart, instead of going to Kroger, people would prefer to go to Target because of the brands that they own, they have, and that they put in their stores. I think it's going to be a good one to keep an eye out on. A 13 PE ratio, the cheapest so far. A 0.87% current ratio. I'm not super concerned. We've seen their outstanding shares continue to drop. We've seen revenue, again, I don't know why they're showing these years, continue to grow. But this is a business that I like. Their EPS has been fantastic so far in 2022. Fantastic as well. I like this business. Main reason being their brands. Target owns a lot of the brands that are in their store. Now, what does this do? What does this mean? Well, you think of Kroger, think of Walmart. They have brands that they do own that they place in store and on shelves. A lot of the trendy, the people that prefer specific brands, they're actually preferring the Target brands. Brands like Made by Design, Opal House. You also have, which one am I looking for here? Room Essentials is a big one. They have Simply Balanced, Embark, Smartly, Everspring has just released. Favorite Day is starting to dominate the shelves in their stores in terms of desserts. Good and Gather is a fantastic food one. The summer brand Some Squad. Goodfellow & Co. is what I actually use to wash my hair with. Universal Thread. Up and Up is literally next to any premium product on the shelf. An Up and Up brand is directly next to it. Specifically with like personal care, food, as well as in-home essentials like plates, paper napkins, and such. They just released their own pet food brand, you could see, and they also have some wine brands and such. But Target dominates with these owned brands. Why does that matter in the grand scheme of things? It's going to be a little bit cheaper for them to source, a little bit cheaper for them to put on shelves. If you think about it, a Procter Gamble product, it's going to cost money to get a Procter Gamble product from Procter & Gamble or from the distributor, however they're getting it from them onto their shelf. It's going to cost money. They're going to have to pay for that product. Now, of course, they're going to have to pay to create this product from Made by Design, Kona Soul, New Day, but it's their own brand. They're actually taking the product, they're making it themselves, and they're putting it on shelves. They lack the markup that normally would occur in that sort of in-between phase. And so when you're buying a New Day, an all-in-motion product, they're actually profiting more on those types of products than they would from a Procter & Gamble or a Starbucks branded product, right? They're going to make a little bit more money. That, combined with the fact that people love their brands and their other brands that are sourced, that aren't owned by them, have been fantastic, staying on top of those trends. They also won Retailer of the Year in 2021, and they're continuing to expand on the online side of things, shipping products faster, getting sortation centers and things like that. So Target is one that I really, really like. I own it in my personal portfolio, but would definitely consider placing it in the Dividend Journey portfolio as well. Last one here on the list is Visa. They have a 0.7 dividend yield, one of the smallest on the list so far, but the highest dividend grade at 93%. This is a business continuing to grow, relatively steady with a 0.89 beta. You could see that their market cap is pretty big. They have a 22% dividend payout ratio, which is good for a stock or in a company that is continuing to grow. Valuation is a bit rich at a 40 PE. Outstanding shares have continued to drop, but their current ratio is better than most of the others here in this side. We could see a more recent revenue growth continuing to go up. Obviously, this business makes massive amounts of money when people spend money, which is one of the reasons I'm slightly concerned with both this and Target, Starbucks, and Procter Gamble. These are all consumer-driven businesses. Now, the good thing with the dividend journey is we're looking to collect profits, but we're not worried about price action in the short term. We're not looking to move on from these stocks in a week, in 2 weeks, in a year, even in 5 years. These are businesses we'll own for a very long time, but is this going to create some type of volatility or unwanted volatility in the portfolio? I'm not sure. In terms of Visa, the actual tangible thing we can take a look at here, this card or this issuer of cards dominates the credit card industry. You can see here, these are by purchase volume. Visa head and shoulders above MasterCard, American Express, and Discover. In terms of credit card purchase volume, again, Visa dominates over 53% of that market share. Credit cards in circulation, about half of them are Visa. MasterCard with 34%, so they take a pretty big chunk actually of that market share, but again, Visa dominates. And then you can see here another thing is that they're not taking on necessarily the outstanding balance by issuer, right? They're providing the network, but they're not like American Express and Discover that do take on sort of these outstanding balances. They are just running that network for them, but they do dominate these networks, both Visa and MasterCard. So this is one that, again, they make more money when people continue to spend money. There has been issues with, the percentages that they are charging, but I think they kind of both manage, both MasterCard and Visa, to navigate those in ways that benefit them in the long run. Of course, blockchain, spending money with Bitcoin and cryptocurrencies is something that's always going to be there, but I think for the substantial future, I think it would be really easy to see when Bitcoin and these big blockchain networks are going to start to take over Visa and MasterCard. I think you'd see the price action of that. I think you'd be able to move off the company, but I don't think that's going to necessarily be in the next 20 years or so. Call me a liar, call me a whatever you want down in the comments. Let me know what you think on that. But that has been the 4 stocks: Procter & Gamble, Starbucks, Target, and Visa. Comment down below, which one of these 4 do you think that I should add? You could go through, you can do some research on your own if you want. If you own any of these businesses, let me know things that you found out in the news recently. Obviously, we would dive a little bit further into the business before purchasing it, probably make a whole video on the business, on the company, on the financials. But let me know what you think down below in the comments. Thank you so much for watching this video. Hopefully, you were able to pick up some form of knowledge on this video. I really appreciate you being here. Hit that like button down below, hit the subscribe button, join the Financial Friends community, join the friend group, and I will see you all in the next one. Take care.